We'll talk market rally. The whipsaws in this market recently are pretty intense, and today was no different. Market up 4.5%, really elevating off of the lows, coming in strong after the weekend. So we're going to break down that action, look at it from a sector perspective, and in the segment shifting stocks, think about which names, which groups are really moving it. Also, Commodity Corner, we're going to look at the movements in gold and oil. Ladies and gentlemen, this is the final bar. Good afternoon, everyone. Welcome to this edition of The Final Bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me today on a rare, incredibly bullish day. It's been a little bit destructive last week as we've, going through these massive sell-offs and trying to uncover some pockets of positive movements. Here we get the reaction that I think last week people were hoping to see at some point, right? With a nice rally, the S&P up over 4.5%, finishing around 3090. A lot of movements, especially in big cap tech. That's where you saw a return of strength, but also in some other areas as well. So there's a lot of kind of interesting themes. I think the biggest question now is this a V bottom? Is this, are we just going to go back and resolve and continue where we started? Or is this more of a dead cat bounce, more of a reaction rally, sort of digesting last week's action before reality sets in and we continue to play out these lows? So we're going to try to look at it from a couple different angles. Before we get there, though, I did want to talk about the upcoming schedule here on the Final Bar and on StockCharts TV. Earlier today, we had our most recent episode of Behind the Charts featuring Fred Meisner from the Fred Report. Next Monday on March 9th, we're going to have Behind the Charts featuring Brian Shannon from Alpha Trends. So some fantastic interviews that we're bringing every Monday there. Coming up on this show, this week we have three fantastic guests. Scott Smith from Briefing.com is going to join us tomorrow. Jeff Weiss, author of Relationship Investing, is going to join us on Wednesday. And then Javed Mirza from Canaccord Genuity is going to join us from the Toronto area on Thursday. So some fantastic guests, and we've got so many good people lined up in the coming weeks and the coming months. Really excited to share some of their insights with you. And again, when the market is this volatile, as we get into the market recap here, hearing from people that have been doing this for many, many moons, I think is more helpful than anything, because as much as our experience can help us navigate these markets, seeing how others have gone through similar periods can be really, really valuable. So look forward to hearing from all of them. Let's get to today's price action. And again, by any definition, this was a pretty extreme up move. This is one of the top up days I've seen in quite a while, following the market for many years. The S&P finishing around 3090. That's up 4.5%, 4.6% from the close on Friday. The Dow up over 5%. Interesting to see the Nasdaq lag just a bit behind the S&P, but both up pretty significantly. Mid caps and small caps actually followed. So it was large at the top, then mid, then small, which again, it's not sort of the, traditional bull market leadership of seeing small high beta names leading the way. In fact, the high beta index or high beta ETF is underperforming right now because it's the large mega cap growth trade, the tech and consumer names that have really been driving things to the upside. This rally today pushed the VIX back down to below 32. It had been up in the 40 handle for a little bit as of last week. Again, this is a very volatile period. We're seeing severe down days followed by severe up days. And that matches sort of what you're seeing in the, with the overall news flow, right? It's sort of feast or famine, great news or horrible news. It's not just kind of okay news, right? I mean, things are sort of very positive or very negative. That's what causes these movements to happen in stocks. Looking over here at the sector summary, you can see utilities actually led the way up about 5.8%. So the XLU was the number one out of 11 S&P sectors. This is coming off of obviously a pretty severe sell-off last week, but a big up move, reversing the distribution that we saw last week. Then we have technology number two, and the consumer staples number three. When we get to shifting stocks, we'll talk about some of the leadership we saw from some of the food suppliers, things like Costco with a huge move up almost 10% today, followed by financials, they're up over 5%. On the downside, we had consumer discretionary and then communication services and then industrial. So this was not just a move back to offense. This was, let's be clear about that. This was not a everything's fine again, we're back to the bull market phase. This was more of a mishmash of reaction, looking at things that should fare well in an extended, challenging period. Some of it may be more of a wishful thinking or an expectation that the impact of the coronavirus will be less severe than maybe what people had expected, or maybe it's just a reaction and what you call a dead cat bounce, which is compensating for how quickly we went down last week, how suddenly we went down, and how severely we went down. So again, let's look at some of the guideposts along the way here to see. In our shifting stock segments, we're going to come to individual stock movers. So I just wanted to get down to some of the ETFs and look at the big picture chart of the S&P here. So the S&P actually number one, China A shares actually and the MSCI World Index both up pretty good. So not as much as the S&P, but up fairly well. On the downside, you have the Hong Kong ETF followed by India and Italy. In terms of industries, we have computer hardware, as I mentioned, food retailers and wholesalers. That's Costco's group and some others in there as well. Automobiles, this would be Tesla. And then you have just a mix of different sectors, things like mortgage REITs up at the top. So again, conventional electricity was one of the top 10 sectors, as was reinsurance. So this is not just a, getting back to what had worked. This is definitely more of a reaction, trying to find pockets of opportunity, I think, in a relatively uncertain period. Let's look at a chart of the S&P, the daily chart, and just see how today's action fit into the big picture. I'm going to start with looking at the last year just to put this into proper context. You can see the type of stepwise movements we had sort of middle of last year, sort of the impulse and then correction moves. You can see how quickly we retraced last week. In the end, we were down about 16% from the high 2 weeks ago to the low on Friday's session, and that put us down to the lows from last August and as well as the first week in last October. So it's sort of the range, sort of that 28.25 to 28.50 range is the level at which we'd expect support, and that's where we hit on Friday. We closed toward the highs Friday, and then we had the real follow through today, which puts the S&P back above its 200-day moving average. It had been below there. This is also coming out of an extreme oversold region. So what's interesting here in terms of how you think about it, again, as always, we start where we're at, we look to the left. So the fact that we have found support at this key level, this range at which we found support last summer, is pretty reasonable. That's pretty reasonable expectation that that's what we would see. Now that we're back into this range, we're sort of looking at the low from last December, which lines up with the Fibonacci retracement level. If we can hold above there, as well as the 200-day, this is the level we broke down through last week that, in my opinion, suggests further downside. And I still think even one day coming back up, to me, I still feel like there is more backing and filling that needs to happen. I would not be surprised if we retest the lows from last week, if not go a little further down, because there's a lot of processing that needs to happen after a sell-off like that. It could be a V bottom and we return higher again. That's super unusual, and I just wouldn't want to bet on that based on the probabilities, right? It's an improbable but a possible movement. So as we're thinking about all of these things, I did want to look at just the breadth picture, just to see how today's movement sort of affected things. If you remember last week, we talked about a number of the ways to measure breadth, and one of the things we would look at would be the advanced decline line. Now, this is going to change pretty quickly based on today's movement, and you're going to have a big uptick in all four of these measures, because this is the cumulative advanced decline line for the S&P, for the New York Stock Exchange, for the mid cap, for the small cap. They all broke down through their swing lows by the end of the day on Friday. So over the weekend, doing my normal weekly review, I switched these all down to sort of bearish mode, because we're in an established downtrend. So what I would remind you is, even with the rally that we saw today, it's not just about one day's rally, it's about the pullback, right? We'll pull back tomorrow or at some point this week, probably. And the question is, where do we rebound down to? Do we establish some sort of higher low, or do we retest those lows that we set during last week? And I think that's the question. Same with these cumulative advanced decline lines. Do we return and get anywhere near the previous peaks? Do we show a sign of better accumulation, or is it still sort of in this downtrend of lower peaks and lower valleys? And again, unless we see more building on what we saw today, I think that's most likely the path of least resistance here for equities. We need to go to our next segment, which is shifting stocks, and I've sort of teased some thoughts about what I'm seeing with equities. I wanted to dig in a little bit further about some of the particular patterns. As I've mentioned to you a number of times over the weekend, I like to look at the S&P 500, just look at individual charts to see what they're saying, see what sort of themes I can pull out. Now, what's funny about today is on a Monday, we've changed the picture dramatically from what a lot of those look like. I want to start with a chart of Apple just to show you sort of what my view was telling me this weekend. So I was looking at this up until today. You had this pattern of lower lows and lower highs. If you look on a closing basis, even with the rally on Friday, a stock like Apple still closed below Thursday's close. So, continuing to go down on a closing basis. We also were coming out of an oversold range. And that was one thing that certainly caught my eye with a lot of stocks, sort of in that oversold to extreme oversold range, with an RSI sort of in the 20 to 30 range. And again, usually that suggests a short-term rally. It suggests a short-term bounce. And the problem or the question is it like June of last year where Apple was oversold and that was the bottom, and then you continue this big uptrend? Or are we now in this bearish range with the RSI not really getting above 60 and the RSI continuing to become oversold? So on a chart like Apple, what I made a note of on my paper was, it's oversold, would expect a bounce, and I would be very interested to see on the rally if the RSI remains below 60. If you look, that's sort of what happened back here, different lead up, but second week in February, the RSI never really got above 60, and that was the top. That was sort of the end of the uptrend as we went down. Arguably, stocks like Apple are now in this bearish range where the RSI never really gets above 60 and will tend to get oversold. You don't really know if that's the case until we fill in some more data, right? So again, based on the fact that stocks sold off so much, and what the chart of Apple tells me is we've become extremely oversold, or I'm sorry, we've become oversold. You'd expect a bounce, but overall, the question is, where do we rebound here? And then what's the next leg down? Are we able to hold above, these lows on an absolute basis, 255? Are we able to hold above the closing low, which is around 273 or so? And if those things happen, then it could be time to maybe consider accumulating or nibbling a little bit. A stock like Apple up 9% has very quickly changed the entire characteristic of this, but certainly that's what I would be looking for. After a big steep sell-off, you look at what's next, and you look to see if that pattern continues. If you look at the names that are up and down today, we can look here at the scooter reports in which stocks have gained the most, and you'll find a lot of things like Costco. Costco is the top name in the S&P today, up almost 10%. Just about there. And so similar to Apple, had a similar pattern. This one was different though, and that Friday actually pushed us below the 200-day. So while our breadth indicator talking about the percent of stocks above or below their 200-day moving average, it went very negative because stocks like Costco broke below the 200-day. Now they've turned on a dime and gone right back up into this congestion area that we've seen for the last 6 months or so. So again, I think that now that we've established this sort of range, remaining above the 200-day is it's pretty meaningful. Again, this is totally normal that you'd expect to bounce. The question now is, where are we able to hold what sort of levels? Next one I wanted to show you was over here on the most up list, the stocks up the most. And again, what's interesting to me, there are a lot of different sectors that are represented. A lot of the charts at the top of the list look pretty similar. So this is another name. This is S&P Global, which is in the financial sector. Very similar pattern. In this case, did not break below the 200-day, oversold, and on a relative basis has actually been a pretty decent performer. On a day that's up, let's look at some of the stocks that got hurt today. And again, I'm always, it's a fair guess that the average chart looks pretty good relative to what it did on Friday. A lot of recovery. So the question is, what was actually leading the way down? What got hurt on a day when things are up so much? And again, it's some of these themes that are not super surprising. So cruise lines continuing to show weakness. So even though there's a recovery of sorts in some spaces, it's not everywhere. And the cruise lines getting hurt so bad, another travel related stocks is certainly one of the reasons why transports, why consumer discretionary sectors and groups are down pretty significantly, because they really didn't recover today. So Norwegian Cruise Lines down another 4.5%. And again, this is after Friday, where it actually was a bullish engulfing pattern, started to look a little more constructive, but giving the gains back, remaining in the oversold region, and the relative strength still going down. I was mentioning to someone asked about, previously, what were some of your better trades, which was fun to relive. And one that I remember was, looking at cruise lines and other luxury stocks around 9/11 in the weeks afterwards. And I remember Royal Caribbean bouncing so beautifully out of these lows as people started to speculate that recovery would be okay. We're not seeing that yet, and I think what you want to look for with a stock like Norwegian Cruise Line is some sort of stability. And again, ignoring the news flow, obviously that's outside of the scope of the show here. I'd be looking for some sort of stabilization, some sort of indication that we're seeing a recovery. You also see some weakness, continued weakness in consumer discretionary within things like apparel retailers. And again, what concerns me about charts like this is that they're in established downtrends, lower lows, lower highs. And again, I always come back to that the slogan, never confuse the bottom of the page with support. Just because something is down a lot does not necessarily mean it's the time to get into it. And if you look at Kohl's, it actually had a nice bounce the first week in February coming out of the oversold region. And as you can see, about a week later, a number of people probably got caught into that, got caught up in the idea that that was a bottoming pattern of sorts. Again, we never really had the higher low. We sort of have continued this stepwise pattern, still below two downward sloping moving averages. So the names that I think could be interesting are ones that are able to, change this pattern, establish some sort of higher low, establishing some sort of indication that things are in a recovery of sorts. We're not seeing that with a lot of those areas. I did also want to point out, I think with personal products, this is an area, as you're thinking about some of the themes that could be emerging, personal products are a pretty decent place because that, there's going to be obviously a lot of demand for that, building demand, depending on how things play out with the coronavirus evolving and expectations. Again, the market is all about expectations. You can see the big rally back above the 200-day for personal products as a group, and again, oversold, alleviating very, very, very quickly. So interesting as a theme, but again, from a technical perspective, I just caution you, remember, any of these really beaten down groups that have rallied today, one day does not change the face of the trend. A trend is made up of not single days, but of an evolution of days over time. And you're better off looking at the peaks and the valleys. We've now established a lower low. Until we get a higher low, the trend by definition is lower on a group like this. So I would caution you to get too excited about some of those groups that have moved very, very quickly out of very depressed levels. That's our segment on shifting stocks. Again, there's so many themes, and I feel like we always just have enough time to tease on some items. I hope you can use our conversation on this show as an opportunity to think about things you want to dig into deeper. And we look at some of those groups, dig into some of the individual names, and you'll find there's a lot of opportunities around there if you just sort of know how to filter through all of those movements. We're going to take a quick commercial break. Back with my next segment, talking about commodities, how the movements in gold and oil relate to what we're seeing with stocks. We'll see you back in a minute. Hello, everyone. Welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close to debrief on the day's action connected to the long-term trends. No better time to come on the show and follow along with us as we sort of try to make sense of all of these, the volatility in the markets, all these sudden movements. And again, if you've not been thinking of support and resistance levels, which as a trend follower up until last week, you probably didn't feel like you really needed it, well, you really need it now, because now it's all about where stocks are relative to where they've been, starting at where we're at, looking left on the chart. I'd encourage you to keep your questions coming. The Final Bar at StockCharts.com is a great way to get your questions to us. Love to answer them in a mailbag segment later this week. Let's get to our next segment, though, which is Commodity Corner. So what we like to do is look at some non-equity asset classes, bonds, fixed income, currencies, occasionally just check in on where they're at relative to equities, which tends to be our focus when we're thinking of movement. So, obviously with the volatility that we've seen in stocks, we've seen similar, severe movements in most asset classes. I want to start with this chart of asset allocation. We looked at this in recent weeks, but just want to update you on how they look, given the last week's volatility and today's rally in stocks. So we have the S&P 500 in black here at the top, in this brownish color, kind of coming down pretty significantly. You can probably guess that is crude oil. In the goldish color here, we have the price of gold, which rallied and then came off pretty good in the last week. In red, we have the bond markets, and in green, we have the U.S. dollar. So starting with the dollar, you can see that it had been a nice uptrend, which sort of supported this outperformance of U.S. relative to global markets. But you can see in the last week and a half, it's actually reversed down pretty good. We're going to look at a chart of the UUP in a second here and think about how the weakness in the dollar has certainly impacted things. But also note gold has come down pretty significantly. So gold we tend to think of as a safe haven, even though the primary trend, I would argue, is still higher. It certainly has come off a little bit, and especially today with the nice rally in stocks, you can, the downtrend in gold almost jumps off the page a little bit more. Bonds are down a little bit today for sure, but more flat to down, not really down significantly overall as an asset class. Arguably the strongest of the five that I'm showing on you here, just in a nice consistent uptrend. But let's look at those two, crude oil and gold in particular. Think about what those movements relate, how they relate to what we've seen elsewhere. So here's a chart of gold. This is going back for 2 years, just so we can see this movement. What we've talked a lot about is the relationship between the last 6 months and the 6 months prior to that. So sort of first half of 2019 to the second half of 2019 into the beginning of this year. Gold went to new highs, and you had this distributive bar here at the top where we opened, gapped up to new highs and closed lower. So far, that's been the peak with the GLD around 158, 159, come down since there, and now it's testing the 50-day moving average from above. So it's above two upward sloping moving averages, which in general tends to be pretty positive. The RSI has remained above 40, which I would argue pretty positive. As long as we stay above there, I think the trend overall remains fairly strong. With something like gold, the things I would be looking for, number one, can it hold the 50-day? Number two, we go down to 145, which was the lows from this pattern here from January. So, a break below 145 would put it below the 50-day. That would certainly suggest a lower low, start to change the complexion of this chart just a little bit. But overall, the main thing I would be looking at is the RSI and seeing if we can hold around or above that 40 level, which again, pullbacks are going to happen. That's totally normal. If we hold that level, that usually means it's more of a pullback within an uptrend. It's more constructive. If we break down through that sort of level, it makes it feel like it's going to be more of a deeper correction, either in price or in time. And again, it can always be either or a combination of those two. So gold in general, has pulled back pretty good, but overall still in a fairly positive trend. Compare that to something like the S&P, and you can see how it's gone down through all those moving averages, back above the 200-day, but overall, much more destruction felt with the downtrend last week. So gold's certainly holding up better. Switching to oil, we're going to start with the USO, which is the U.S. oil ETF. Now, I'll tell you, and we're going to look at a chart of crude oil here in a minute. USO is good just to see the current trading, see the bounces. As you go longer term, it disconnects from the price of crude oil, the contract, because of the rollover, because of the way that the ETF is calculated. You have a decay because of the futures. So long story short, it doesn't match the long-term return profile of oil as much as you might like. Same with the UUP and the dollar spot index. They don't move identically. In the short term, they will. They'll have similar percent moves, but the further you go back from today, the more the trends are disconnected just because of the calculation. But I just wanted to highlight that oil was up pretty big today, up about 5%. So it's coming off of a fairly negative level. This puts the USO, brings it off of the lows that we saw going into the market low, the equity market low last week in December of 2018. So we've retested that low, and now we've bounced a little bit. Again, this one day does not tell you that we've recovered. It just tells you it may be the beginning of something. We have to see what happens next. So if we look at a longer term chart of oil, I sort of think of it this way. If you look at oil from the end of December, of 2018. This is the equity market low, and this is where oil prices bottomed out as well. It's sort of in this range, sort of the 42 to 45 range, and we've gotten right back to that level. This is not updated for today. Oil will be up here in the 47-ish handle, but you can see that we've potentially bounced off of support. So one of the questions with commodities, can they come out of these extreme oversold levels, these extreme negative levels? What's interesting here is you saw the bullish divergence at the lows in November, December of 2018 with the higher lows in the RSI. We've potentially started to do that here as well. And again, with the update that we saw today, that's probably going to cause the RSI to come out of that oversold level. And all of a sudden you have another bullish divergence. And again, not telling you all is clear, but could be an interesting indication that things are coming out of a period of weakness. That would certainly seem to buoy energy stocks if that would sort of that would sort of play out. So switching to the sectors here for a second, here's a chart of the XLE. There we go. So you can see the XLE actually went way below the lows from the end of December. Again, coming out of an extreme negative position. I don't have the RSI on here, but oversold in a very similar pattern to what we saw there. So the question is going to be, is this the beginning of a little bit of more of a rally? So energy stocks up 4%, not as much as the broader S&P, but up a decent amount. And so again, if commodity prices would stabilize, if they would come up, that would certainly indicate energy would be an effective way to engage that sort of move from an equity or from an ETF standpoint. So that's sort of the overall configuration. So just to summarize with commodities, we've seen oil come out of extreme low levels. We've seen gold in an uptrend pulling out of those negative levels. And then if you look at the commodity ETFs, you can see them here, very similar to the chart of gold, very depressed, coming out of extreme oversold readings. We'll have to see if that's the beginning of something further. But we need to wrap up the show by going to the 3 and 3. So at the end of every show, 3 charts, 3 minutes, and let's get to it. Chart number 1 is looking at the relative performance of the equal weight S&P to the regular S&P. So there's a lot of ways that we look at market breadth. One of the ways I like to think of it is looking at the equal weight version of the S&P, all 500 stocks weighted equally, versus the cap weighted S&P, which is very much geared toward the largest names, the mega cap names, the FANG stocks, big tech, etc. If you look, this has been in a consistent downtrend, and you can see the downtrend has actually accelerated in the last 6 months. You can see the trajectory was one thing going into October, November, December, and then 2020 has seen that line accelerate to the downside. It really speaks to the relative strength of the mega cap trade in equities. And again, all that tells me is that the recovery that we saw today, while widespread, still is leaning very much on the biggest stocks. It's not the small cap stocks and equal weighted portfolios, still not doing very well. Chart number 2 is a chart of the dollar. We talked about it in the commodities segment, but I just wanted to point out the UUP is right at that RSI 40 level. And for me, that is so important because that will tell you whether it's something like last October and last December, where it was a pullback before resumption of the uptrend, or if this is a deeper sell-off. And if the RSI breaks meaningfully below 40, that tells you that this might be more of a downtrend in the dollar. Getting to our third chart, what that does is it starts to affect the relative performance of U.S. markets versus non-U.S. markets. So here, I'm looking at emerging markets versus EFA. So this is global emerging versus global developed markets. You can see that this has reversed course, and emerging markets are really outperforming in February. Part of that is because of the dollar strength. Dollar weakness, but it's also about the commodity strength that we started to see, arguably. If you look at emerging markets versus the S&P is still overall the place to be because the trend here is still down. So emerging markets have done better than global developed markets, but still not quite as good as the US markets. And we rallied very quickly last week because of the sell-off, but pulling back just a little bit, the question for me is going to be, is that able to stabilize? We put a higher low in that ratio, may mean you should start to think about emerging markets, the potential for a weaker dollar and stronger performance from non-US markets, particularly emerging. Ladies and gentlemen, that is our show for a Monday afternoon. Again, a nice rally in stocks that I think is leading a lot of people to question where we're at. And I would encourage you to bring up a lot of charts of individual stocks, look at where we're at, look to the left, focus on those key support and resistance levels. You can catch all of our previous shows on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.